What is a dividend reinvestment plan, DRIP, for investors? Have you ever wondered how you can make your investments work harder for you? One way to do this is through a dividend reinvestment plan, often referred to as a DRIP. This plan allows you to automatically reinvest the cash dividends you earn from a company's stock into purchasing additional shares or even fractional shares of that same company. Instead of receiving cash payments, your dividends go straight back into buying more stock. This reinvestment takes place on the dividend payment date. What's great is that many companies offer this service without charging commissions or fees. Sometimes, you might even get to buy shares at a discount to the current market price. So how does it work? When you enroll in a DRIP, the dividends that would normally be paid out to you are used to buy more shares on your behalf. This process can be managed directly by the company, through a third party, or via a brokerage. Each time you receive a dividend payout, it buys additional shares, which means you own more stock over time. One of the benefits of a DRIP is that it supports a strategy known as dollar cost averaging. This means you are buying shares regularly, regardless of the price. Over time, this can help lower your average cost per share, which is a smart move for long-term investors. Now let's talk about some practical benefits of DRIPs. First, there is the power of compounding growth. When you reinvest your dividends, those additional shares will generate their own dividends, which can be reinvested again. This cycle can lead to significant growth over time. Another advantage is cost efficiency. Since many DRIPs do not have trading fees or commissions, you can increase your investment without worrying about extra costs. Plus, the convenience of automatic reinvestment means you do not have to time the market or make decisions every time you receive dividends. DRIPs also allow for the purchase of fractional shares. This means that every dollar you receive in dividends is fully invested, maximizing your growth potential. However, there are a few things to keep in mind. Even though your dividends are being reinvested, they are still considered taxable income. You will need to report them on your tax returns. Additionally, because the reinvestment happens automatically on dividend dates, you do not have control over the purchase price. This means you might end up buying shares at a higher price than you would like. Also, if you are a short-term investor seeking quick gains, a DRIP might not be the best fit for you. Dividends are typically paid out quarterly, semi-annually, or annually, so you may prefer to buy shares directly on the market instead. Lastly, if many shareholders participate in a DRIP, the company may issue more shares, which can dilute ownership percentages for those who do not participate. Overall, dividend reinvestment plans are a solid option for adult investors focused on long-term growth. They provide a disciplined, low-cost way to build your investment positions while taking advantage of compounding returns. If you are looking to accumulate wealth through dividend-paying stocks, a DRIP could be a great addition to your investment strategy.